Okay. Good morning, everyone. So, our group represented the company, the institution is ARK Capital. So, our group members got Tan Si Han, Osborn, me, Chester, and Liang. So, let's talk about the background of the ARK Capital. So, the ARK Capital founder is Catherine Wood. It founded in 2014. So, they are focused on the revolution technologies and making some investment that in long run business. So their company launched its first four active funds, which is next generation funds, genomic funds, innovation funds, and autonomous funds. Also, they are got other funds that like robotic funds, space explorations. In December 2020, the innovation ETF became the largest active funds. On January 11, 2021, the company became one of the top 10 issuers of exchange-traded funds. Next slide, please. So let's talk about the challenges of ARK Capital are facing. So they are facing the fund, they are racked up millions in fees as investors suffer the billions in losses. So they are losing the 10 billions over the fund's lifespans and more than 2 billions since 2022 alone because of the US monetary policy began to be tightened. So all the cash reliant technology sectors are slumped. So invested in a large number of innovative companies whose stocks price have suffered very seriously setbacks, and the fund fell around like 50%. So I'll pass it to next presenter.
So hi, I'll talk about the cause of the crisis. Cathy and ARK Investment Management Fund achieved an impressive annualized return of 160%, earning her the nickname of Goddess of Stock among investors. However, following its peak in 2021, ARK has experienced sustained loss in EFT asset, with nearly 15 billion in outflow due to the loss in subsidiary tech loss. So several factors contribute to a decline. The first is impact of rising interest rate. The Federal Reserve tightened of money policy, including rising interest to combat inflation, distribute the ability of cheap money. This leads to a sell-off in technology stocks, which are often associated with high growth and valuation. And this will lead to investor preference of the value stock for the demand of growth stock, which are the focus of Cathy Wood investment strategy. And now move to the right side. Despite the challenge, Cathy Wood remains commitment to her investment strategy. She believes that mature tech company may struggle if treasury yield rise to 3%, but her favorite super growth companies will fare better. And then Cathy Wood investment style lack proper risk management and that her investment were reckless. However, Cathy Wood continue to stick to her approach and struck of the criticism. Okay, next slide, please. So now I'll talk about the institution current risk to the risk we learned in class. Next slide, please. The first one is the interest rate risk. Rising interest rate risk has made it harder for investors to buy into unprofitable companies that promise future growth, reducing demand for risky assets and hurting the performance of Cathy Wood funds. And increasing interest rate increased borrowing costs for business and individual, leading to reduced investor demand for risky assets. During period of rising interest rate, investors tend to favor immediate profitability and choose safer for more stable company to invest. Nevertheless, Cathy Wood investment preference are those high growth companies, especially those in the technology and innovation industry. Usually, the value of these companies are based on their future profit potential rather than their existing profitability. Okay, that's all for me. I'll pass it to next presenter. Thank you.
Okay, moving on, let's talk about the potential solutions for institution challenges. There are four solutions that we have discussed on following. First is the risk management tools of cut loss. We also can know it as a stop loss. It is used by stock market traders and investors to reduce possible losses. The main goal of a cut loss is to stop or reduce the losses on an investment. By using cut loss orders, investors can limit the severity of their losses by avoiding several downturns or subsequent reductions in stock price. For instance, it is preferable to leave or sell off a stock at a reasonable loss price rather than waiting for it to fall even further in the event of a significant downturn in a stock in which a company has invested. By using this strategy, it could encourage discipline in the company's investing goals and tactics. And the second one is the reducing leverage. It is a crucial component of risk management since it lowers the cost of borrowings of investors. They increase the overall profitability of their operations and generate more cash flow for reinvestment on other users by using less debt to finance their initiatives. For instance, reducing leverage from 100 times to 75 times or below increase a stock's fault tolerance gap, making it more resilient to turbulent market conditions. A company's financial stability can be increased by putting efficient risk management methods into place, enable it to better handle market swings. Next slide, please. So come to the third one, diversifications. We also can diversify across a variety of businesses, geographies, and asset classes. It can help to reduce portfolio risk in the finance sector and achieve a more consistent overall return by diversifying one's holdings such that the positive performance of other assets can offset the negative impact of one investment's performance. Instead of relying entirely on one industry, a corporation can diversify across several to reduce risk. For instance, we can invest in fixed deposit, foreign exchange, gold, and etc. So the last one will be the contracting a commercial bank or central bank for assistance. A variety of risk management options are provided by the central banks to help people and businesses manage risks and protect their financial interests. It might consider alternatives including getting loans, seeing a financial advisor, or asking the central bank for help, even though it might not be the best option. But these steps can assist the business in navigating challenging situations and preserving its financial stability. That's all for my parts. I'll pass to the next presenter.
So let's come to the evaluation of the leadership effectiveness. So after the crisis occurred, ARK Capital implemented cut loss strategy. ARK Capital reduced their holdings from more than 50 stocks to 28 stocks, have over 2 billion in losses. The core benefit of cutting losses is protecting their remaining capital during a turbulent market and reallocate their capital into a more promising investment opportunities. So, however, there's a risk by implementing the cut loss strategy as well, which is premature exit. In such a volatile market, price fluctuation up and down frequently will cause false signals and interrupting the analyzer to exit the market before a potential rebound. So it's a double damage to the firm, especially when the firm is already suffering from losses. So it will also miss the potential rebound and potential gain like missing the long-term gain when if there is still a potential profit gap in between the price. So next strategy will be the concentration strategy. ARK Capital is the ARK Capital implemented concentration strategy, which is focusing on a specific industry instead of diversified their portfolio during the economic downturn. By implementing this strategy, they're able to fully utilizing their assets, their capital to purchase undervalued stocks. So when the market turn bullish, they will get a higher return. So this is totally opposite side of what their counterparty are doing, which is selling stocks and buying indexes during economic downturn to diversify their portfolio. So in trade-off, this strategy is a long-term period due to the economic cycle take averagely range from 28 months to 10 years to up to 10 years. So thus buying and holding the stock will locking up their capital for a long period. So when the capital is heavily tied to the performance of market, if there is any unexpected crash in the market, our capital will be very vulnerable. So other than that, they will also missing out many investment opportunity in other industry as they only focus on a specific industry. So that's all for my part. I will pass it to the next person for the conclusion. Thank you.
Lastly, let me to conclude all the above. In conclusion, the key findings indicates the vulnerabilities of ARK Capital in the face of market factors and investor preference. The tightening of monetary policy by the Federal Reserve, specifically the increase in interest rate, due a significant impact on the firm's investments. With less money floating into the market, it has become more challenging for ARK Capital to sustain its performance. Furthermore, some analysts have criticized Catherine Wood for her investment style and perceived lack of a proper risk management plan. For the recommendation plan, cut loss or stop loss, lowering leverage, diversifications, and assistance from commercial bank or central bank are the suggestions can help ARK Capital deal with problems head-on, safeguard their money, and put themselves in a position for long-term success. To successfully navigate uncertainty and protect its financial interests, the organizations must place a higher priority on risk management, discipline, and diversify. The organization will be more resilient, financially stable, and able to sustain growth despite shifting market conditions overall, thanks to a comprehensive and strategic strategy. That's all for our presentation. Thank you for the attention.